The biggest mistake you can make as a dividend investor is chasing yield, and I've been guilty of this too. It's easy to look at something like JEPI, for example, with a near 10% yield and immediately start seeing dollar signs, but you have to remember building wealth and reaching financial freedom is a marathon, not a sprint. If maximizing your dividend income is something you're after, then believe it or not, a high yield approach is actually going to result in less income 20 to 30 years down the road compared to this different approach that I want to talk about in today's video, which I think is your dividend portfolio's secret weapon. Now, as a starting point, let's actually look at a high yield approach, and in our example here, we'll assume you're just putting 100% of your funds into JEPI, which is a strategy I do not recommend, by the way. This is just for the sake of simplicity here in our hypothetical example. But anyway, by doing so, your starting yield would be super high right here, 10%, and we're not going to account for much dividend growth or share price appreciation from JEPI because really this is more of an income investment. And then just a few more stats. We're going to start with an initial contribution of $1,000, and then we'll be adding $1,200 to this portfolio every single year, so $100 a month. By the end of that 25th year, your portfolio would be valued at just over $113,000, and in that 25th year, you'd be generating about $11,850. And then one more thing, your starting yield would be 10%, but after that 25th year, your yield on cost should be 36.04%. And yield on cost is a very important metric for dividend investors that we need to expand on a little bit more. So obviously, we're all pretty familiar with the dividend yield. This is the dividend paid per share divided by the stock's current share price, but yield on cost is a little bit different. Yield on cost measures the dividend against your average cost per share instead of the current share price. And as an example, imagine you invested $1,000 into a stock that has a 3% dividend yield. Now, in that first year with a 3% dividend yield, you'd receive about $30 in dividend income. Now, assume that the company increases its dividend by 5% per year on average, which is a much higher number than what we were using for JEPI, if you remember. Anyway, after 10 years, your dividend income from that same initial $1,000 investment would go from $30 in that first year to about $58.50 in that 10th year. And this would leave you with a yield on cost of about 5.86%, which is nearly double the current dividend yield in this time period, still 3%. And this number will continue to grow, this yield on cost, as time goes on, which happens as a result of the dividend growth. In fact, after a certain amount of time with a higher amount of dividend growth, your yield on cost, as well as the dividend income that you're generating in this portfolio, will outpace a higher yielding portfolio that doesn't have as much dividend growth. Hopefully that makes sense. When I was first getting started with investing, yield on cost wasn't something that I really understood. It was kind of a hard thing for me to wrap my head around. Admittedly, this led me to invest most of my money into stocks like AT&T, Verizon, and Altria Group early on because I saw that they had a high yield, which I thought meant they were better for some reason. And as a beginner, I think this is an easy mistake to make, especially if you're like me and came into this with zero financial background. You know, I didn't go to school for this stuff. I pretty much learned everything I know about investing so far on my own. But in hindsight, pursuing this stuff for my formal education when I was going to college would have really helped me out, especially as a brand new investor. I probably would have approached all of this a little bit differently. And on that note, I want to talk to you about today's video sponsor, Southern New Hampshire University. As someone who actually didn't finish college and most certainly wasn't after a degree in finance when I was going, there are times where I don't feel the most qualified to talk about some of the topics we cover here on this channel. Because of that, I'd be lying if I said that I've never thought about going back and finishing my degree. And if you feel the same, if you feel like your experience is holding you back from pursuing the career that you really want, then I am so excited to tell you about today's sponsor, Southern New Hampshire University. SNHU has one of the largest accredited nonprofit online degree offerings in the country, and I want to talk to you specifically about their finance program. In this program, you'll learn to identify long-term corporate investment opportunities to increase shareholder value, apply theories of asset allocation, security analysis, and portfolio diversification to efficiently manage an investment portfolio, utilize the rules and regulations for financial accounting and reporting in a global economy, generate financial records and financial statements for users in accordance with governing rules and regulations, and analyze, interpret, and communicate financial and accounting information to internal and external stakeholders. SNHU is radically affordable, with their tuition rates being some of the lowest in the nation. Also, when you go to request information about one of their 200 plus different programs, a real person will hop on the call and discuss how the program can benefit you personally. To learn more, go to snhu.edu/Ryne or find the link in the description to find out what the current average annual salary is for someone with a finance degree and to request more free information about the program. It only takes one click to find your calling, so once again, go to snhu.edu/Ryne. But anyway, getting back to the topic of yield on cost and dividend growth, I think the perfect real-life example of just how impactful this can be is Warren Buffett and his famous investment into Coca-Cola, which he writes about in Berkshire Hathaway's most recent shareholder letter from 2022. He writes, in August 1994, yes, 1994, Berkshire completed its 7-year purchase of the 400 million shares of Coca-Cola we now own. Wow. The total cost was $1.3 billion and a very meaningful sum at Berkshire. The cash dividend we received from Coke in 1994 was $75 million, which would have given them a yield on cost of nearly 5.8%. But by 2022, the dividend had increased to $704 million. Growth occurred every year, just as certain as birthdays. All Charlie and I were required to do was cash Coke's quarterly dividend checks. So $704 million in dividends from a $1.3 billion investment would come out to a 54% yield on cost today, which is a much higher cash flow return than you'd ever experience investing in something like JEPI. And I say that reluctantly as someone who has a few shares of JEPI in his portfolio. But anyway, this isn't rocket science, and Warren Buffett isn't the only one who can get these sort of returns, as it really just comes down to buying assets that will grow steadily over time and having the patience to see it through, which for many is the hardest part. Like I said earlier though, taking this sort of approach will generate more income for you over the long term as opposed to going all in on the high yielders that don't offer much growth. And to really demonstrate that, let's compare our $1,000 JEPI investment from earlier to a similar investment into SCHD, whose dividend stats are perfect for a dividend growth strategy. So in this SCHD example, everything's going to be more or less the same. Same starting investment, same annual contribution of $1,200, same time period, 25 years. But the only thing we're changing is these right here. Instead of a 10% yield, we'll use SCHD's 3.5% yield. SCHD's 5-year dividend growth CAGR is somewhere between 13 and 14%, but we're going to be a little bit more conservative and say 10%. And then we're also going to be conservative for the share price appreciation. We'll say 6%, and when you add that to the 3.5% yield, we're looking at about a 9.5% total return. But anyway, with SCHD, after 25 years, you'd be left with just under $160,000, which is about $46,000 more than if you would have invested in JEPI. Now, as far as income goes, you'd be bringing in about $14,600 in that 25th year, which is about $2,800 more than if you would have invested in JEPI. And then last but not least, your yield on cost would be 41.26% with no signs of slowing down, compared to JEPI's 36%. So there's about a 5% spread between the two here. So overall, some sort of high dividend growth investment strategy takes the cake compared to a high yielding strategy over time. And while high yielding stocks may have their place in a portfolio and do offer that instant income gratification, it is the dividend growth stocks like the 5 great ones in this next video right over here that are your portfolio's secret weapon for building long-term wealth. So click right over here to check them out, and I'll see you in the next one.